Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, October 11th, 2018. I want to go over not just the broad markets, I want to go over what stands out right now as trading ops, and more importantly, if you're new to the site, something that I try to always keep a balance of, and I talk on the importance of, is not only diversification, which means don't put all your eggs in one basket, don't have it all in one stock, don't have it all into gold. Spread it around, spread your positions around. Whether you're an active trader or investor, it's just as important to be diversified. And then asset allocation. That's especially in investing, but I use it in trading too. Tactical asset allocation, because swing trading is really just investing fast forward. There's day trading, but that's not what the site's about. I do day trades. I'll share them in the trading room every now and then. But for the most part, I'm a swing trader and trend trader. And swing trading, you're just trying to capture these trends that can last for anywhere from days to months, but usually a few weeks to a couple months on average. And now, asset allocation is where you diversify your portfolio among different asset classes. Stocks being one, equities, Apple, Amazon, everything in the S&P 500. Those are companies. Those equities. Then you have bonds, and they come in different flavors: government bonds, high yield bonds, corporate bonds, municipals. Then you have commodities, and there's a whole variation within commodities. Gold has nothing to do with sugar, which has nothing to do with timber. And so by using strategic asset allocation. Let's short the most bearish, anything that stands out as bearish, go long the most bullish. And what it does, it helps you fire on all cylinders. If it's like driving an old 8-cylinder car, for those of you old enough to remember before everything was completely run on computers. If you had an 8-cylinder car and one cylinder went out, the car still drove. It might sputter and kick, but you could still drive. And that's the whole premise of asset allocation. If you're long stock or your short equity portion of your portfolio is crapping out this week, maybe your gold's doing great. And that's the whole premise there. All right, to the charts. All right, SPY has big down day. I thought we might get a green day today and or tomorrow, and I still do. Today was red, so that leaves me now one day to be right on that bounce. Now what I'm looking at is um, we came close, but we didn't quite tag that 268.33 level. Would have been nice to see that today. So now maybe another gap down in the morning and then a reversal. It's a pretty well-defined support level. I've had that level there for a while. And something I want to point out, and this is very important because I know a lot of you are still short. Anything's possible. We dropped more on this drop here earlier in the year than we have so far. We can certainly go down more, and I still think we will see these lows back there from earlier in the year sometime here at the end of the year. That's what I've been calling for a while. I was calling for that up here. That could happen tomorrow. It could. I doubt it, but it could happen tomorrow. It could happen next week. We could continue to slide. We may consolidate here and then continue lower. But what I want to point out here is or are the overbought conditions. If you're new to trading or investing or technical analysis at least, this is the RSI, the relative strength indicator, and it shows you how overbought or oversold the market is. And the levels, although they're not marked here, that red line's at 70. That's considered anything 70 or above is oversold. Overbought, I'm sorry, and anything 30 or below, this blue line is oversold. This is a deeply oversold reading, 17.64 on the RSI. We haven't been that oversold in years. This goes back 2 years, and I'm sure I could go back even farther, and we won't see that for quite a while. What does that mean? Well, does it mean we can't go down anymore? No, because as I always say, oversold is not in itself a buy or sell signal. Although in a bull market, it usually is. It's usually good buying up. Now, this is showing a change of character right now because again, that's about as we just kissed those levels earlier in the year. Again, I made the case where we've got some long-term trend lines. The market may have seen its highs for the bull market. That's very, very possible. It's also priced into the charts. But if not, all I'm trying to get at here is new bear market or not, when you get this oversold, prices have moved down impulsively without hardly any consolidation to work off those oversold readings. The potential for a sharp snapback rally short squeeze, short covering rally. It all happens. If we snap back, you get the shorts squeezed out, people that are still short, longs pile in, and you can snap back quick. And where the danger lies mostly, it's hard to trade futures now with the volatility. You have to give them room. But in those index tracking ETFs, you could have a big move in the futures overnight. The market could open up 2-3% in a day and gap blow you right past your stop. Stop loss orders will not be filled unless if you have a stop market order, stop order, that gets filled at the market, at the opening price, whatever it is. No matter where your stop loss order was, stop loss orders are filled at the open. They turn into market orders. So you got to watch them on gaps. The other option is a stop limit order that will only be filled at your price or better, but boom, the market gaps beyond your stop limit order, it will not be filled. It will sit there. You're still in the position watching the losses pile up or the profit give back. So be careful there. That's all I'm trying to say is be careful with these oversold conditions. I talk about risk reward a lot. Yeah, some big technical damage done, but it's just not objective to add short exposure. I'd rather watch the market drop another, uh, you know, 5% or so, whatever it takes to get down there, and then find objective long entry and miss out on some more short profits. And again, we still have swing short trades. I have personally, but I'm talking about the index shorts. We closed out TWM yesterday, hit our final target. And I think what SRS today hit the final target. So there's a theme here too. These targets are being hit and they're all around the same levels. And usually when the final targets on trades I have to start getting hit in close proximity, that means the correction's usually over. That's been my experience historically. So that's that. What else did I want to show you here real quickly? Weekly chart. Like here's the bull market uptrend line. I've talked about this a lot. Like I said, this is a pretty darn bearish situation here. We have a divergent high. Doesn't mean we can't push up and add another one. We had a divergent high right here. Actually, it was right here. A little divergent high, a little correction. We pushed higher. But what makes it different this time around, I've talked about, is this trend line. Now, oh yeah, here's what I wanted to talk to you about. This week's candle. Big, red, bearish, everything you want to see. Again, and this is just a follow-up to last week. I mentioned that last week. We had confirmed bearish engulfing candles on QQQ and SPY. I love to see them. They're great sell signals, and I love when they're followed up with downside, which it is. And they're topping candles, so that could mean more downside to come. But this corrections can play out in two ways, time or price. This one was pretty sharp in price, so it may, before we get a bounce, it may not last long. But here's what I wanted to get at. Is the weekly charts. They mean a lot. I think they're very significant to me, but I only really put emphasis on how they look on a weekly closing basis. And the reason is this is our candle now, and it is below the trend line that I have, that important trend line, bull market trend line. It is also below the 40-week moving average, which has contained the uptrend as well. But as we can see here and here, we've had intra-week breaks before, and that's why you want to use a weekly closing basis. So if tomorrow we snap back and mount a nice rally to close back above that 40-week / 200-day moving average right there, the red line, or even better for the bulls, or just to delay the downside here, we could snap back up on that trend line there. It'd be a pretty good recovery. Let me try to measure it out, see how much we'd have to do tomorrow. It's about 2%. Very doable. So if we pop up 2%, what we're going to do is hang up back, right, park the SPY right on the trend line for the week, just like we did here. Here, that was a red candle. That means we closed there. Here, and we're still above trend. So I wanted to point that out. We're oversold. Yeah, I can make a case we're going a lot lower in the coming months. Maybe it happens sooner, but again, the risk reward's not good. And especially if we close the week tomorrow green, then they may build on that, and we could have a rally the following week, build on those gains. So that's SPY. Here's QQQ. There it is. Nasty big red candles. Great sell signals. There it is. There's your bearish engulfing. But here's QQQ. It is now below that trend line. This doesn't come off the 2007 lows like the other one. This one comes off the 2015 lows, but there's that 40-week moving average. Does a bang-up job of defining support on uptrends in QQQ and resistance in downtrends. But usually you can look at it back here. You'd have to put up on your chart. I know it doesn't show that clear on this one here, but when I zoom in, you can see it. And there it is. We're within you know, a stone's throw of recovering that tomorrow. And that would park us on the 40-week moving average. That 40-week EMA, I've told you before, does a great job of defining uptrends, bull and bear markets. I've used it for years to help define bull and bear trends in Apple. I have a different chart on stock charts I could show you. It goes back farther than this one. And we're well above that level right now in Apple. But a lot of bearish developments, bearish crossover, everything else. So I've gone over the equity markets quite a bit. I don't want to spend too much time on those, but I did want to point out that again, it's a correction, but the odds for a snapback rally now are pretty good, and it's just not very the risk reward is not very compelling at this point to start adding shorts. I'd rather look for either a bounce to trade. We tried that TQQ, didn't work out. No big deal. Losses were minimal. We'll try it again. Or if I have to wait, I'd like to see another bounce back and get in short again at the right time. That's what I'm waiting for now on equities. All right, 10 minutes spent on equities, and it's really the thing I really didn't want to spend a lot of time on because that's not right now where I see the opportunities. Let me get to what I do like right now. Gold, very much like gold. If you followed the site for a while, I've been following, waiting for really well, not just one thing, but for a large part, one thing to happen. I'll get to that in a second, and that is the charts of gold futures, a 60-minute chart. I was waiting for a break of the 1213 level, a convincing break, impulsive, and we got that today. This is a weekly chart. I was on a weekly time frame of the markets a second ago. I just want to point this out so I don't forget it. I mentioned in the trading room just like I pointed out last week, those bearish engulfing candles, which are some of my favorite, is topping patterns. Bullish engulfing candles are some of my favorite bottoming, and it's not even a pattern, it's a stick. But you want to see a follow through. So two things. Today is only Thursday. The market's closed now, so we have one more day. The more gold can build on today's gains, the better that is. And I don't see on this weekly chart, I don't have any resistance up here to about 117.46, and we closed at 115.78. Now, I'm not saying we have to get there tomorrow. Great if we do, but I want to see this stick hold. Even if we give back some of the gains, we come back in here. That was a resistance level we took out today. I had on this weekly about 114.89. I'd like to at least see that hold. In other words, I want to see this bullish engulfing candle hold. What does that mean? The body, the fat part, has to remain above the body of this previous candle from last week. And again, the more we build on it, the bigger that bullish candle, the better it is. And I've mentioned this quite a bit. I've been doing a lot of updates on gold. I like this. Nice clean separation on the PPO, and we have a bullish crossover on the PPO. Low level down low with clean separation. Again, what I mean by clean separation, when gold or any securities in a sideways trading range as it was up here, chopping around, don't trend indicators, I throw them out the door. I don't even pay them any attention because you're going to get whipsaw signals. I like trends. When you get clear trends, you have clean separation of these lines, and then boom. So what happened back here the last time you had a buy signal gold? Well, we kissed the 30 level. We were oversold, just as we are coming off oversold levels now, and that was followed up. The oversold reading was followed up by a bullish crossover afterwards to confirm that the trend has flipped to bullish, and that was from there. Gold rallied from lows to highs about 21%. So again, I've covered this a lot in the past, and I'm still going off the assumption that gold is in a bull market, most likely that started back here in December of 2016. It's still made higher lows so far, each major low, but there's some work to be done. It's mostly a sideways range. It has been upwards, but we have to take out this level, 130.50 in this trend line here, and that'll really open the door for, I'm talking a trend trade, where you can. This is why I like gold, and this is why I'm talking about it now, as I think it makes sense in a portfolio, long-term accounts, IRAs, even a trading account, because the potential is pretty good on it, especially if you look at the miners, which tend to go up a lot more when gold rises. They follow the metal, and they go up much more in percentage terms. Cuts both ways. They go down more too when gold drops. There's on the daily chart, big, look at that green candle, beautiful breakout. I had that downtrend line here, that 113 113, well, we'll call it 114-ish level, which was very good support in the past. So I'm seeing just check boxes across the board today in gold. Everything I've been wanting to see. That was an important level. It has been recovered after spending a little time below it and consolidating. The downtrend line was taken out. It was taken out impulsively. I don't know if you can make it out here. There is a huge volume bar. Breakouts that occur on above average volume have a much higher rate of success, meaning a lower rate of failing, that being a false breakout. So I like what I see so far, and yeah, that's why I put it on as a long trade, even though we're already long GDX. Speak of the devil, there's GDX. There's that inverse head and shoulders pattern I've been highlighting recently. Double shoulder, boom, blowout. This is again what you want to see. This is a breakout. There's the neckline. We gapped up right up to the neckline and built on those gains all day. Not the best number, 6.66%, but as far as that whatever thing. But there it is. So we have still plenty to go if that head and shoulders is going to play out. So let's see these. Hopefully these gains will get built on. There was a little bit of resistance about where GDX stopped. There was a gap, I should say, that was right there. It was pretty much parked at backfilled that gap right there. So again, if we can build on these gains, and I think we will, great. I mentioned in the trading room, and I think I might have covered, yeah, I covered it in the video this morning. If we get an impulsive move, because that was my expectation. So if we get a little more work on the dollar, I just want to see a little more evidence that the dollar has topped and the euro has bottomed, then we can have a pretty strong, powerful unidirectional rally. If that's the case, you may want to roll from a GDX long into a nugget long, because I mentioned that 3-time leverage can actually work to your favor, where you can actually outperform GDX by more than 300% if you get a pretty strong rally. Might be a little early now. Let's just see how we close the week before doing that. Maybe I'll do that for the official trade. We'll see. And then GC, I told you I'd talk about the futures. Let's find those. There it is. So here are those levels I've been talking about, and as of up to this morning, and you can see nice downtrend line, lots of reactions, boom, 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 and then I love that 1213 level. I've probably said the word 1213 100 times or more in the past couple months, and then boom, it took it out, and like I said, the more test of a support or resistance levels you have, and the longer a basing pattern below it, and it's testing, the more impulsive move. And this is one of the biggest moves, as I just showed you with that big candle, in gold has in years. And this is not coincidence. There's nothing fundamentally that drove this today other than a technical breakout, just as that breakdown in the markets occurred recently, 100% driven by the technicals. You can certainly say, yeah, there's catalysts that usually trigger breakdowns, and the high, the rates increase in Treasury rates may have been, that's what I think the press is assigning as the straw that broke the camel's back. But I just wanted to point this out. So let's watch this. Work to be done on gold and gold futures, but looking good so far. Let's just not, I can't knock it at this point. If the breakout fails, it fails, and I will update my thoughts as soon as possible. Euro US dollar, still, like I said, still flirting. It has recovered that level, so another bear trap whipsaw signal. It's bullish that we recovered that level, but again, if you look at where we're at, bigger picture is, there's a big sideways trading range. We need to get above the top of that range. We need to break out up here and then run, and same thing with the dollar, needs to move lower. Here's what the dollar ETF looks like, and again, I've covered this chart. You have these divergent high, negative divergence at the highs. And we had a breakdown, a little kickback rally, another kickback rally. So if the dollar can really start to move lower and getting some traction to the downside, that will propel gold prices higher. And we do, as far as official trades, we have a pretty fair concentration right now, or at least a number of active trades that are in the precious metals category. I mean, that should obviously speak to my conviction right now. But what I want to get at is keep that in mind with your position sizing. Birds of a feather flock together. You're not going to see gold go up 30% and platinum down 30%. It doesn't happen. They do, each metal has their own thing, but gold, platinum, and even silver, although they all have both industrial and precious metal applications, but for the most part they're going to move together. Again, not in perfect synchronicity, but the trends will pretty much mirror each other. And today we came very close. First target on this one is 80.22, and we hit a high of 80.10. So based on my outlook here, I often will personally cover, reverse a trade as an active trader when a first target's hit or expect a reaction. We may get a reaction there. In fact, we almost did really. I had that target real tight to the resistance level, and it did pull back off the high. So let's call that the reaction. What I think will happen, we'll probably break on through there. In other words, I have no desire. I think it's probably best to just keep your stops in place or raise them at this point, or if T1 is hit, and then ride this one out to T2. And if you're a longer term trader investor and you want to tuck this one away, I can tell you the long term chart looks good too. This is a weekly chart I just jumped over to, and I'll mark it up here for you, show you some big, strong, powerful divergent lows. Let's see if I can get a downtrend line here off the highs, maybe. Yeah, I'd have to play around with it. I don't want to waste too much time in this video. There it is. There's a pretty nice fit. So that's platinum, and what you want to see in the coming months, you can certainly have a little resistance there to overcome. That's probably about where I have that first target. But eventually we work our way up here. This is a bullish pattern, and we could break out, and just to kind of give you an idea of where this one could be headed in 2019 or maybe 2020, probably 2019, I think, is all the way up here to about 130, and that'd be about a 64% gain. So that would be a longer term swing target for platinum. Okay, finally to wrap this video up, let's just look at a few commodities. I mentioned that it's another way to diversify, another type of asset to have in your portfolio. And I've over the years on right side of the chart traded these actively. At times, personally, I might use futures. Sometimes I'll use these ETNs. Some of them track better than others. The ETNs that don't do a good job of tracking are natural gas ETNs. Sometimes they can track okay. UNG, some of those are awful, but a lot of these, corn, coffee, they do a pretty darn good job of tracking the future. So I have no problem with them. They're not leveraged or anything. They're just rolling, trying to track the futures contract. Some obviously do better than others. We learned that recently, or I did with our sugar trade. I'll get to that in a second, but there was a reason I used a different ETN. But here's corn, divergent low, bullish divergence, just like we had back here. I guess this might have been an official trade. There was a target hit back here. So you can see my trading style. It's very simple, at least in my opinion. Simple, but pretty effective. Look for these divergent lows, look for buy signals. That might have come on a 60-minute chart. I don't know where. I can't remember back then. Here was another divergent low. There was a nice swing trade. That's a key level up there, 1850, by the way. That's why that level, I think that's why I have that yellow. Just like the 1650 is a pretty key level here. I'll show you why. So see back here, it was support. And we sliced through it a few times, but we also had a reaction over there. And you know what, I could probably draw a downtrend. This is what I should have done on sugar. Looks like a breakout recently, came back in a little on a pretty impulsive move up today. Bullish engulfing candle, but it doesn't come at the bottom of a downtrend, so I'm not putting too much significance in that, but just a nice big green candle. Either way, you can see all these are lines. I'll have to study this chart a little further to give you some targets. I'm watching this PPO curl over. I'd like to see it get back above the zero line and not make a bearish cross. If it makes a bearish cross, corn may want to come back in, back test this at lower levels. We might get an entry there, and that would look something like this. Extend these bullish divergences out and get a divergent low here, somewhere else. So corn's on my radar as a potential trade idea. I'll pass it along now. It looks pretty good. Maybe just take a partial position if you're thinking about scaling in. DBA, Invesco Invesco Agricultural ETF. Divergent low right here at this point. Line should be extended. A little breakout, didn't do much. It was a lackluster breakout, and it started to move higher since. You can see some targets there. I think this one's probably good up to about 1835. And let's see another one here. Let's look at wheat. WEAT. This is the wheat ETN, and again, one that I've traded many times in the past. And these are actually, I'll have to look at, these are old trades, old targets, but what I'm looking at here, I have an uptrend line that it's holding right now so far. And just below that uptrend line, I have a support level around 612. So I like this one because it has a confluence of support below trend line and price support. And so maybe if we can buy it around here, but what I need to do is look at the futures chart. I want to confirm anytime I see a bullish or bearish setup on these ETNs, I like to confirm with the futures because that's the real thing. Sometimes these ETNs don't do a perfect job of tracking, whereas the futures, that's what the financial market is, a professional's trade. All right, Cane, CANE. Well, that was our active trade recently. We bought it here. We effectively hit the first target. Would have hit the first target. All the, sugar futures, everything else went up more. This underperformed. I mentioned that to members of the site. I used to trade SGG, the other sugar ETN, but that company eliminated SGG. They replaced it, changed it, had a new ticker symbol, and moving that to the over-the-counter market. I didn't know what was going on with that company, so I went with this one. Either way, we hit that, but I mentioned when we hit it that I still like sugar, so you could stick with it. It's done a decent job lately of tracking, but again, SGG, and I'll show you that in a second. Here, let's just pull that one up. SGGFF is what it is now. You can see after that first reaction, it had a higher thrust. It also outperformed percentage-wise here. So had we gone with my old tried and true SGG, which is now SGGFF, we would have had an 18% gain instead of whatever we had, and this one was about a 25% rip. So I still like it, by the way. Big divergent low. I like the longer-term outlook. And I also think you're going to see, which we're seeing, I think that's part of the catalyst for gold today. When the markets are starting to implode, money's coming out of equities, and there is a tremendous amount of liquidity sloshing around the system, despite the quantitative tightening that they've done so far. The Fed has injected so much money, all the global central banks, into the financial system. That money found its way into Apple, Amazon, drove them to nosebleed levels. It's going to find a home somewhere. So commodities, if the technicals are there or whatever reason, they start buying them. That's where we might have some nice trading opportunities. So, if you're new to the site and you're a long-term investor, you don't like to short, and you're like thinking, well, Randy, what if you're right? What if we're in a new bear market? It's going on for the next couple of years. Where am I going to make money? Well, you don't have to short stocks. You can, but if you don't want to short stocks, commodities, gold, bonds, other things like that. This video is going long, so let me wrap up and have to get to treasuries, but a couple more commodities. This is NIB, the cocoa ETN, divergent low right there. You can see the bullish divergence. Could run from here, but I have a line drawn. Maybe it comes in, works its way down. If it does continue to work its way down, I have a really nice support level down here. That's all these reactions down here, that orange line. But I may not get there. Commodities, if they start perking up, this one can break out. So cocoa is on watch, and you can see all the price targets in the past. We've traded this one before, and you can see looks like some nice exits on those. And we short too. I don't, I'm an equal opportunity trader. Long, short, doesn't matter to me. I have no allegiance to any security, any stock, the markets, wherever the opportunities are. So this might have one soon. I just wanted to kind of throw out there. There's coffee, another one looking good. I need to change these lines. What I need to do is give you this right here. There's our divergent low. Move this one over here. And there it is. That's what it should look like. So divergent low right there, trend line break, breakout, boom. Just like we had a divergent low and a breakout there, and a divergent low, breakout and a rally there. And this one could be bottoming too. So we might be looking, these were swing trades on a bearish trend, a downtrend. We could be catching a bottom here in commodities soon, just like we might be catching a top in the market. And then we're not looking for 10, 15%, 20% gains. We're looking for 30, 40, 50, 80% gains if we can tuck away a trend trade and hold on to that for several months or more. Wood, this is one I regret. I was doing extensive coverage here, calling, looking for a major top in lumber prices. This is a timber and forestry ETF. The charts played out exactly as I thought they would. I just never added it as a trade. I just want to update that. A little breakdown back test of the small wedge. We went on to break my primary uptrend line, back tested, and then boom. So you can see, and I put a chart up the other day on that overlaid lumber prices with the one of the economic indicators showing you that lumber prices have now, it's clear to say they've topped, and they've usually topped shortly before before the economy. So this should be a warning sign. It's certainly a red flag, whether it plays out again this time or not. This looks like a pretty good canary in the coal mine for the U.S. economy. So not good for the folks calling for the bull market to continue to roar throughout 2019. And the last one, long video, I have to run as well, so I'm going to wrap it up, but I meant to cover this earlier and I forgot. TLT, I like it. I keep talking about liking it and planning to add it to an active trade. I probably should have done it yesterday. I should have done it a couple days ago. It jives with everything I was talking about. This is a daily chart. What my scenarios, if you're new to the site, the scenarios I've laid out in recent videos, what was this? A big level here. See all these reactions, that line at 116.50 right around there. Very important level. We broke down. And there's, normally a break of support, especially a well-watched support, is a great shorting entry. I mean, you could have made a quick trade, but my scenario was and still is that this will prove to be a bear trap for several reasons. Technicals, well, you can only there's a technical case. I'm going to make it here in a second on long-term charts, but fundamentally, my theory is this: there is a negative feedback loop in the system. This market has ballooned to these, tremendous gains in excessive valuations because of the free money and the low interest rates that have allowed, economic growth to flourish. Companies to borrow money at next to nothing, like Apple, that didn't even need to borrow money. They were so cash rich they couldn't even figure out where to put all their cash. But what did they do? They went out and took out a bond offering just to be able to buy back stock because their interest rates are so low on the bonds. If somebody comes up to you right now and says, "Here, do you want a loan? I'll give you a $500,000 loan for 0.25%, 0.5%, or whatever it is." Wouldn't you take that money and go and turn around and invest it in something paying 1-2% or do something else with it? Yes. So that's what happened, and that's why we had such a tremendous bull market. But what happens now? All those, debt service, both for the U.S. government and those bonds, are coming due. A lot of debt's rolling over, and this market's not going to tolerate rates going much higher. It's this Ponzi scheme has been fueled on free and cheap money, and it's going to need that. And actually, I don't even think if the rates come back down, it's going to really do much for the market now. But I just wanted to say that from a fundamental perspective. So rates have hit a ceiling. There was an article in the Wall Street Journal I covered recently, or I think I mentioned on the site, about the magic numbers, about 5% on mortgages, where refi activity is predicted to virtually shut down. And that's why the banks are falling. Somebody said rising rates are good for banks. Yeah, only to an extent. But then after a while, it is not good because now all the refis and new mortgage and other loan initiation drops off. So that's where banks are making a lot of their money. So no, rising rates at this point, if they go much higher, would cripple this economy. So again, so that's my point. So why treasuries? Well, the downside risk, if my theory there is correct, is minimal. I think as the stock market corrects, and we're already seeing it. I predicted this last week that we'd get a drop here, we'd break below here, and then when the stock market starts correcting, you'd see money flow back into treasuries for two reasons. Number one, they are the king of risk-off assets, flight to safety assets. Institutions flock to them, individuals do. So when you buy bonds, the price goes up. So that's first and foremost. Add to that, when the stock market drops, as it just has, what happens? Economic growth forecasts and expectations drop along with it. What does that do? That drops long-term interest rates. See, long-term interest rates are not set by the government. The government issues treasury bonds. They do not control the long end of the curve. They control the short end. They control the money that banks loan money to each other, federal funds rate, discount window. They cannot set the rate on the 30-year treasury. That's set by supply and demand, market forces. So when future economic growth expectations start to drop, interest rates drop. When rates go down, bonds go up. So there it is. There's my two-prong approach. Fundamentally and technically, it's here in the charts. We have a big falling wedge. This line right here that I'm highlighting, this line and this line down low. And so what that will do, if it plays out, if we can reverse soon, we have this strong bullish divergence, just like we had a divergent high right here that led to this big correction that's still going on, really. So I think the divergent low will do the other thing, take us up there. And if it does that, it's also going to do one other thing. It will give us that bear trap scenario. So there's the technical case I've made now. Divergences, if we snap back above there, all the folks that shorted government bonds on that breakdown, I'm sure there were a lot of them, will get smoked. Their shorts will quickly be underwater. They'll have to cover. That short covering will trigger additional buying, and that should propel us up to the top and ultimately out above this wedge. So I just have to get the numbers up there. I'll wait for the right entry. Maybe if we get a bounce in the market, we might get a little pullback in TLT, and that might be our entry. So maybe tomorrow or next week, and then I'll give you guys some price targets. All right, long video, but those are the things I'm watching, really the main themes. And then I'll work over the weekend. But I've never had trade ideas so light on the site now, especially after the last couple of days. We have had so many hit their targets and close out. So I will work hard to look for some individual stock trade setups to put on as official trade ideas. Try to get that out starting next week. And this has been Randy Finney with Right Side of the Chart. Hope you enjoy.